I recently received a question from a subscriber. Hi, Warren. I've got 10 grand sitting in cash that I want to put to use. I have my eye on Chipotle and Eli Lilly. I know they are far from each other from a sector standpoint, but can you review these two stocks and let me know what you think? Should this subscriber bet on Chipotle's burrito bounce back or ride Eli Lilly's weight loss rocket to the moon? Two titans, two different stories. One's getting hammered after disappointing earnings. The other's fighting off valuation concerns despite blockbuster drug sales. Let's settle this using live Seeking Alpha and Morningstar data plus a quick AI sentiment check. By the end, you'll see the recommended exact allocation split, entry points, and why our choice might surprise you. Seeking Alpha has a nice tool here where you can put in any ticker and you can compare the metrics between the two stocks or ETF or whatever you want to do. So pulling up this comparison tool from Seeking Alpha, and wow, look at this. We have a big difference in price. Chipotle right here, ticker CMG, closed today at $44.38. Eli Lilly, LLY, $762.95. But price alone tells us nothing about value. Looking at the key metrics, Chipotle has a $60 billion market cap compared to Eli Lilly's massive $685 billion. Chipotle is down a brutal 27% year to date, while Eli Lilly essentially is flat at a negative 1.5%. As we move down to the ratings, both stocks currently have a quant rating of a hold, while Eli Lilly has a Seeking Alpha analyst rating of a buy, and Chipotle has a hold, and the Wall Street analyst rating both have these stocks at a buy. As we go down to the quant factor grades, valuation, Eli Lilly is scored an F. Chipotle a D minus. Growth A plus for Eli Lilly.
Oh, yes.
Chipotle a B. Profitability, Eli Lilly an A plus. Chipotle an A. Momentum a C. Chipotle a D. And EPS revisions a D plus for Eli Lilly, and Chipotle is a B. What it appears to me is Chipotle is getting punished for execution issues, while Eli Lilly faces valuation skepticism despite phenomenal growth. So let's dig into Chipotle more. We're going to go into its internal screen here, the financials. As I said earlier, the stock is down 27% year to date. As you look here, the quarter two numbers tell a brutal story. Revenue came in at $3.06 billion, up just 3% year over year versus $3.11 billion analysts expected. Same store sales declined 4% compared to the positive 11% growth in the prior year. Traffic declined a devastating 4.9%, and earnings per share hit 33 cents a share, which was in line but uninspiring. This was Chipotle's worst quarterly performance in years. Management called it a perfect storm with economic uncertainty, value competition, and smaller group sizes all hitting at once. But here's what the doom and gloom headline miss. When we look at the Seeking Alpha profitability tab, Chipotle still maintains a 40% gross margin and 17% EBIT margin. Earnings before shares and taxes, which is nice. You can hover over these if you don't understand. The EBIT margin trailing 12 months is a financial ratio that measures the profitability of a company calculated without taking into account the effect of interest and taxes. Chipotle's return on equity is an impressive 43%. And return on equity is a ratio which refers to the return on common investors on their investment. Return on equity is used by some investors to assess the likelihood and size of dividend that the company may pay out in the future. Chipotle doesn't pay a dividend, so keep that in mind. If we head over to the valuation tab, this is still a money printing machine. The valuation reality check shows a forward PE of around 36 versus their historic average of around 45. Enterprise value to sales of 5.2 times versus peak levels, which were near 8 times. And the stock is trading at 33.5% below its 52-week high. Chipotle is trading like it's broken, but the unit economics remains best in class. They're opening 300 plus new stores this year and still have a runway to 7,000 locations in North America alone. Now let's look at the pharmaceutical giant everyone's talking about. Eli Lilly's story is all about two blockbuster drugs driving unprecedented growth. In Q1 2025, total revenue hit $12.7 billion, up 36% year over year. Their Mounjaro diabetes diabetes drug generated $3.84 billion, up 113% year over year, while Zepbound weight loss treatment brought in $2.5 billion, which is 4 times the prior year. Their 2025 guidance calls for $58 to $61 billion in revenue versus $49 billion in 2024. These aren't just good numbers, they're historically unprecedented for big pharma. Eli Lilly is riding the obesity treatment megatrend that could hit $139 billion by 2030. Going over to Morningstar, Morningstar flags the obvious valuation concern. Looking at the current numbers, Eli Lilly trades at 62 times trailing PE, 14 times price to sales versus an industry average of around 4x, and EV and EBITDA is high. The stock is trading 15% above Morningstar's fair value of $650. Eli Lilly trades like perfection is guaranteed, and any hiccup in drug approvals, competitive threats, or pricing pressure could trigger a major correction. Now let's go over and see what Perplexity AI says. Here I did a prompt. Please aggregate analyst sentiment on CMG versus Eli Lilly for better risk-adjusted upside in 2025 and 26. Analyst sentiment comparison. Chipotle versus Eli Lilly for 25-26 risk-adjusted upside. Based on comprehensive analyst research, Eli Lilly emerges as the clear winner for better risk-adjusted upside in 2025 and 2026, despite Chipotle's higher absolute upside potential. Here's the detailed analysis. Eli Lilly, superior risk-adjusted investment case. Strong analyst consensus. 22 out of 28 analysts have a strong buy. 79% are bullish. Median price target of $972.50. Price target range of $650 to $1190, with most targets above $900. Recent upgrades from Goldman Sachs and Morgan Stanley. Fundamental strength, $730 billion market cap, 45% revenue growth in Q1. 2025 revenue guidance, $58 to $61 billion. Strong pipeline with GLP-1 drugs that we talked about. Risk profile advantages, a beta of 0.40, financial health score 73, diversified revenue streams across different medical sectors, manufacturing capacity expansion, expected increase production 60% in first half 2025. Chipotle, higher risk, cyclical recovery play. Mixed analyst sentiment, 25 buys, 9 holds, 0 sells out of 34 analysts. Median price target of $59.50, which is a 32.6% upside. Recent upgrade from BMO Capital with a $65 target. Current challenges, same store sales decline 4%, flat same store sales growth, stock down 33% from recent highs, higher volatility and risk score of 34. Recovery potential, June showed positive momentum with 8% comparable sales growth. Management confident about returning to mid-single digit growth. Strong brand loyalty. And it gives you a chart here of the different sell ratings. A nice little graph. Risk adjusted analysis. Why Lilly wins. Lilly beta of 0.4. CMG exhibits higher volatility. For risk adjusted returns, Lilly returns. Volatility with solid upside is preferable. Earnings growth, Lilly sustained 30% plus, and Chipotle flat growth in 2025 with the recovery uncertain. Market position strength, Lilly dominates in a $95 billion GLP-1. CNG facing competitive pressures from other fast casual market contenders. Execution risk, proven drug pipeline with multiple revenue drivers. CMG dependent on operational turnaround. Conclusion, while CMG offers higher absolute upside potential of 32.6% return versus 27.5% for Lilly, Lilly provides superior risk-adjusted returns for 2025 to 26. Lower volatility, more predictable growth, stronger financial positions, less cyclical exposure, higher analyst confidence. For investors seeking risk-adjusted upside, Lilly is the better choice, offering substantial growth potential with significantly lower volatility and execution risk compared to CMG. More speculative recovery story. So then I ask, if a moderate risk investor, which is our subscribers' question, had $10,000 to invest, what allocation should the investor put towards these two stocks, or none, or only one? What strategy would you employ? Please include stop loss, profit targets, entry points, and provide an investing game plan. Investing game plan, 10,000 moderate risk. Recommended strategy, overweight Lilly tactical CMG position. For a moderate risk with 10 grand, I recommend a 70-30 allocation favoring Lilly over Chipotle. Position allocation details tells you to buy 9 shares of Lilly, so that's about 7 grand into that. Chipotle, 64 shares, which is about $3,000, and then so a little bit of cash here. Then it's going to tell you about entry strategy and timing. Lilly, primary entry, current price $7.62. Basically do a market order, dip buying, $7.14 is the support level if it market declines, and it's telling you to DCA over 2 to 3 weeks. CMG, wait for support, enter near 45.74, which is a volume support level. Current price risk 46.76, may face resistance at 52.78. Breakout strategy, consider adding more at 52.78. Basically, it's telling you if it gets above this 52.78, it could be off to the races. Risk management framework, Lilly 678 is your stop loss with Chipotle at 43.45. Exit all positions if the total portfolio declines 15%. So if you're down $1,500, get out. Hopefully those stop losses will come into effect. Position sizing rules, profit taking strategy. Target 1 for Lilly, 881, which is a 22% gain, and once you take half profits. Target 2, 991, 30% gain, final exit, or do trailing stops. Rationale based on analyst median target of 972.50. Chipotle profit targets. Target 1, $50, 13% gain, take 30% profits. Target 2, $63, 35% gain. Full exit on recovery. Rationale, $59.50 target by analysts. Investment horizon, 12 to 24 months. Monthly revenues. What it wants you to do is monthly reviews, portfolio performance and rebalancing needs, quarterly rebalancing, maintain 70-30 target allocation, and exit triggers. Alternative strategies by risk tolerance. So some of you, if you're more conservative, do an 80-20 split with Lilly 80 and Chipotle 20. More aggressive 60-40 split, single stock option, Lilly only. If you want to be simple with a lower risk, or a Chipotle only, not recommended due to higher volatility and execution risk. Key success factors for Lilly: catalyst, GLP-1 drug adoption. Risk, competition from Novo Nordisk, monitoring quarterly earnings, drug trial results. Chipotle, catalyst, same store sales recovery, operational improvements. Risk, consumer spending weakness, competition, monitoring, monthly same store sales data, management guidance. Final recommendation, execute the 70-30 split, risk adjusted returns, diversification benefits. You got different sectors here, pharma and restaurant, upside participation. CMG offers cyclical recovery potential, moderate risk profile, balanced approach suitable for moderate investors. Gives you the timeline. Week 1, enter Lilly position, dollar cost average 2 to 3, CMG with your support, and that. This strategy provides estimated 20 to 25% portfolio upside over a 12 to 24 month period. In closing, the subscriber must understand the risk they are taking. For Chipotle, a consumer spending downturn could extend the same-store sales decline. Food cost inflation on avocados, beef, and chicken could squeeze margins further. Competition from Qdoba, Moe's, and other fast casual chains is intensifying. And there's execution risk under new CEO Scott Boatwright. For Lilly, FDA setbacks on pipeline drugs could crater the valuation overnight. Medicare pricing pressure on GLP-1 drugs is a constant threat. Novo Nordisk competition is intensifying in the obesity market, and valuation compression could occur if growth slows to only 20 to 30%. So there is the roadmap. Chipotle offers classic contrarian value as a temporary wounded champion, trading near 3-year lows with intact fundamentals. Eli Lilly gives you exposure to the obesity megatrend, but requires paying a 65 times PE premium. The 70-30 split reflects this reality. Lilly gets the larger allocation because the growth runway is clear and longer. Chipotle gets meaningful weight because the risk reward is compelling after the recent sell-off. Both positions are sized to survive 50 to 20% drawdowns without panic selling. Now that you know how Seeking Alpha, Morningstar, and Perplexity AI data revealed the real story behind Chipotle's sell-off and Eli Lilly's valuation concern, concerns, you're going to need to watch for 3 critical catalysts: CMG's Q3 same-store sales recovery, Eli Lilly's pipeline FDA decisions, and any Medicare pricing announcements. Because if you miss these turning points, you could buy Chipotle right before another leg down or chase Eli Lilly into a valuation trap. Let me hear from you in the comments. What stocks would you like for me to cover in my next deep dive video? Are you having trouble deciding between 2 stocks to invest in? And as a reminder, you can join my Substack. The link is in the description. And if you sign up for my premium subscription, I will do a portfolio review for you. And as always, smash that like button, subscribe to the channel, and also drop your Chipotle versus Eli Lilly take in the comments, and let's make some money together. Thanks for watching.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.